Hello and welcome to BQ Prime. You're joining us in this special broadcast where we're discussing the RBI's latest salvo against unsecured loans. And to discuss this further, we have with us Mr. Dinesh Kumar Khara, the chairman of State Bank of India, India's largest lender. Mr. Khara, just to take our viewers through the events that have happened since last evening. The RBI has introduced fresh risk weights, higher risk weights for unsecured loans by banks and NBFCs. In fact, loans from banks to NBFCs who are in unsecured lending, there as well, the RBI's new risk weights are going to come into play. It's about 25% higher in all cases. I just wanted to get to know, sir, from you, what is the systemic impact looking like? How much of this can we say that is directly linked to the unsecured lending that has been happening over the last few years?
Well, I would like to start by saying that pre-COVID, the risk rate for the unsecured loan used to be 125% only.
Yes.
So now, during COVID period, this was reduced to 100, and now it has been restored back to 125. So I think to that extent, this is something which was the practice in the past, and now once again, it is now being brought in. And also, it has to be seen in the context of the concerns being expressed by RBI governor in terms of the growth of the unsecured loan book, and more so the loan book, which is unsecured loan book coming from fintech lending, BNPL kind of things. So those are the kind of things which are actually cause of concern, and it would have impacted the system at large. So that is perhaps the reason why this further step has been taken. And I look at it in the overall context, it's a very positive and a healthy move.
Understood. Sir, my next question is with regard to State Bank of India itself. At this point in time, I think you have on the unsecured side about 3.7 lakh crore worth of personal loans. Any fear as far as that loan book is concerned? This higher risk weight will obviously carry a higher capital charge. Anything on that front?
Not really. We have done some calculations, and as far as the unsecured loan book is concerned, we expect that it will require additional capital consumption of another 30 basis points or so. And even if we look at the loans to our NBFC also, then another 25 basis points are something which are expected. It will consume another 25 basis points. So overall, the impact of these new guidelines will have to be exceed over 55 basis points. If we look at our half-year profit ratio until now, it could have given approach to our capital adequacy ratio of about 109 basis points. So as compared to that, these revised instructions will come over 55 basis points. So we have sufficient growth capital, and we will be in a position to grow well. So we don't envisage any challenge on account of this higher adequacy effects.
Okay. In terms of the lending to NBFCs, now there as well, the RBI has introduced higher risk weights. To your mind, is this going to result in higher borrowing costs for the NBFCs? Will banks sort of review how much they're giving out in loans?
Actually, much of it will depend upon the blend of resources which NBFCs have. If at all, NBFCs are dependent upon the corporate bond raising, so perhaps it will help them in sort of reducing their cost. So, as I mentioned, that depending upon what is their rating and external credit rating, and what are the sources which they are tapping for really augmenting their resources, that will be the deciding factor for NBFCs. And I think, there would be some impact is what we expect, but how much of that will be there, it will differ from NBFC to NBFC.
One point I wanted to also confirm with you is the introduction of sectoral limits as well as sub-segment limits that the RBI is talking about. It says that the board has to come up with these limits, and the banks have to abide by those limits. So far, whenever we talk about sectoral or sub-segment limits, we think of wholesale loans, and now suddenly it's coming for unsecured. Is this brand new? Will this have any impact on the way you lend? You, in the sense, banks in general.
We have been having the internal exposure limits also, sectoral limits also, when we build up various portfolios. So at the board level, we do have delegation, very conscious delegation, and accordingly we lend into various sectors. So that is a guiding principle which is already there. The guardrails are already in place. I think RBI wanted to formalize across the system. We are already practicing that.
Okay, fair enough. One last question that I wanted to get from you, because you're the largest lender in the system, but this sort of means doom for a fintech lender who anyway did not have a wide variety of sources for financing. And now, if they are part of the RBI's RE definition or regulated entity definition, then the cost for them goes up. Not sure if the returns will keep that in check.
I think perhaps we'll have to, we'll have to wait and watch how really it works out for them also. But yes, of course, the normal expectation is yes, of course, the cost for them will certainly go up, and which will have an impact on what they're lending.
All right, Mr. Khara, thank you so much for taking time out and talking to us, sir. Pleasure talking to you.
Thank you.
All right, so that's Dinesh Kumar Khara, the chairman of State Bank of India, taking us through what he feels this is going to lead to. Of course, indiscriminate lending is going to be curbed. State Bank of India, as such, doesn't expect a huge sort of capital charge on its capital adequacy ratio. But yes, things need to be watched for, and we need to see how this affects the system going ahead. We will keep track of that at BQ Prime. Do keep watching bqprime.com for further news and updates. Thank you so much for watching.